One of my favorite top-down analysis techniques, without which I cannot start my trading day, is studying higher time frame maps. For instance, if I plan to trade using a 4-hour time frame, I will create a monthly map for that asset and explore trading opportunities accordingly. These maps consist of the high and low values from the preceding trading month. They can be extended to the right and utilized as potential thresholds for price action in the lower time frames during the subsequent month. In this scenario, following a significant drop in the Bitcoin chart over 3 consecutive months, April, May, and June, the emergence of a bullish candle can indicate a decrease in bearish momentum. This may signal a period of consolidation and recovery. Given that the bullish candle in July is an inside bar completely contained within the high and low of its preceding candle, we may choose to assess its effects solely for the upcoming month, which is August. To determine the upper and lower thresholds for that month, we will draw 2 horizontal lines from the high and low of this candle. Subsequently, when we scale down to the 4-hour time frame, it becomes evident that by the end of July and during August, highlighted within a box, the price is forming a noticeable wedge pattern that is on the verge of completion. For those of you who are not familiar with the concept of a wedge, I should mention that the wedge pattern is a price action formation that may have a bullish or bearish angle, resembling a triangle. Price action inside a wedge typically consists of 3 consecutive legs, with each leg surpassing the high of the previous leg in a bullish scenario. When the wedge pattern is about to complete, it typically suggests that a significant reversal move in the opposite direction is imminent. Moreover, the waning strength becomes quite apparent when we utilize the momentum indicator on our chart. Additionally, there is often a noticeable divergence between upward moves and the RSI indicator. I consistently recommend to all traders that they take into account the overall market structure in higher time frames as a vital component of their chart analysis. A wedge pattern is a reliable price action formation that, even without specifically noting its formation location, can be a strong indicator of a market reversal. When we incorporate the element of being at the top of the trading range, drawn based on a monthly map, it becomes even more compelling to exclusively consider short trades when we identify the right setups. If we want to analyze the chart with more scrutiny, we can detect that the third leg of the wedge is another wedge on a lower degree. Therefore, if any price reversal happens here, it would be massive. Therefore, it is imperative that we stay alert and avoid late entries. Before progressing with this example, let me take a brief detour and acquaint you with the various types of pullbacks that can occur after the price exits a pattern. In the first scenario, which is the most common and widely accepted, the price taps into the broken trend line. Afterward, by forming reversal candlesticks, it resumes the path in the direction of the breakout. In the second scenario, the price action is more vigorous, and during the pullback it only touches the line drawn from the breakout point, which is extended to the right. In some rare cases, the price breaks a trend line and moves a substantial distance from it. However, after a while, it rebounds to the breakout point and initiates another impulsive move. In the third case, which is often observed in wedge and flag patterns, the price fails to reach the breakout point. Instead, it retreats to a specific level of support or resistance within the pattern. And finally, sometimes after breaking a pattern, the price retraces back into it, a phenomenon known as overshooting. In such cases, it is likely to touch a strong support or resistance level inside the pattern before reversing. Returning to our trading example, we observe that once the wedge formation in the lower time frame is complete, the price moves away from the pattern with a large bearish candle. Subsequently, it retraces to the breakout point, rejecting those levels with a long wick. This could serve as an early signal to go short, and from my perspective, it presents an excellent entry point. We can enter the market at this point and place our stop loss above the 2 wedges. However, traders who exercise more caution may choose to wait for the break of the lower trend line of the broader wedge and seek selling opportunities after a pullback. As I mentioned at the beginning of this video, the appearance of 2 consecutive wedge patterns in different cycles is a clear sign of a reversal with significant momentum. As evident here, the price experienced only a brief pullback before plummeting sharply. As for take profit, the initial and most reliable target in a wedge pattern is always the pivot point that initiates the formation of the lower trend line. However, with the monthly map in consideration, we can think of the lower boundary of the trading range as the ultimate take-profit level. As the market progressed, we reached the expected level. Please note that our take-profit target was achieved a few days into September. While this level of deviation is acceptable, if the price continued to linger and the distance became wider, we might have considered exiting the trade manually. Moving on to the next example, which occurred almost a year after the first one, we observe that Bitcoin's price has somewhat recovered from the bear market, showing evident signs of strength. Among the predominantly bullish candles, the one that stands out is the green candle in June. It has engulfed two of its preceding candles entirely from top to bottom. As I extensively discussed in my previous video about these types of candles, we understand their potential for greater influence compared to inside bars. Therefore, we anticipate that the monthly range drawn from the high and low of this candle will likely establish a broader trading range in the 4-hour time frame, possibly spanning across at least 2 or 3 months. As we shift to the 4-hour time frame, we notice the price has entered a prolonged trading range, offering potential short opportunities in lower time frames. However, for those aiming for bigger swings, a short entry might be considered once the price exits the trading range and experiences a pullback to the lower boundary of the range in the 4-hour time frame. As you may have guessed, we chose the lower side of the monthly map as our ultimate take-profit level. However, the price encountered quite a struggle before reaching that level. If you pay close attention, you can detect the formation of another trading range near the bottom side of the monthly map. Therefore, we can devise another breakout strategy similar to what we executed at the top of the trading range, but this time to capture a potential bullish swing. Please note that these attempts to escape from the trading range were fakeouts, as the price didn't show any signs of reversal when it pulled back to the top of the trading range. However, on the third attempt, it managed to genuinely break away from the trading range. When it rebounded, clear signs of reversal were evident, unlike the last two encounters. Considering all this information, we can take a long position after the formation of this strong bullish candle and select the upper side of the monthly map as the ultimate take-profit level. Subsequently, the price successfully broke through this level with a substantial candle and continued its upward trajectory. Keep in mind, besides monthly maps, incorporating weekly and daily maps into your analysis can significantly refine and enhance the accuracy of your trading decisions when combined effectively. Thanks for watching.